morning once again, Charged Up Studio listeners. This is Danna Olivo, your host and CEO of Market Atomy, LLC. And today we've got an exciting show for you coming up. This is Lane Kawaoka, right?
Yeah, thanks for having me, Dana.
Yes. Lane is the CEO of simplepassivecashflow.com. Lane, welcome.
Yeah, aloha, everybody.
So you just had a brand new baby. Tell us about it.
Yeah, first kid. That's what all Simple Passive Cash Flow is all about, right?
Yes.
To,
Girl,
money
boy?
to a girl. Yeah.
A girl. Cool. Oh, they get harder as they get older. I've had one boy and one girl, and I tell you what, the boy was so much easier.
Oh boy. Oh,
So
this seems
enjoy
kind of hard
the
already.
girl while she's little, because once she hits around 10, 12 years old, that's when the trouble starts.
Right. Got to borrow my gun collection from my friend. Occupancy's gun.
No, that's true. So tell me a little bit about, your organization, what you do. How do you benefit solo micro entrepreneurs?
Yeah, so today I own 4,800 rental properties. We didn't always kind of start off like this. My story kind of starts back in 2007 when I graduated college with my engineering degree.
Okay.
My kind of story is, as an engineer, I was never really fulfilled with that type of job, nor did it really pay the bills and then some to be able to be financially independent. I started investing in real estate, and today we at Simple Passive Cash Flow educate other folks that to learn how to invest more passively, right? Because I think when people think of real estate investing, you think of all like the house flipper shows, the HGTV shows, much more active, riskier type of real estate activities. I want to refrain from, to me, it's not really investing. Investing is passively investing so that your assets work for you harder than you work for your money.
Okay. All right. So I've got some experience in this. Okay. And I'm going to get down to some nitty gritty questions for you as far as this is concerned, because not counting what's on TV, HDTV, or HTV or whatever, any of that. Let's talk a little bit about the real estate market. And right now we know it's a seller's market as far as that's concerned, at least here in the Eastern United States. I don't know. Where are you from, Lane?
Yeah, it's a national thing right now, right? Okay. Low supply. You could argue whether it's more demand or not, but essentially prices are dictated by supply and demand. And right now we're in a period of very low supply with very few people putting homes on the market. And that's what's making the house prices go up.
Exactly.
But as cash flow investors, passive cash flow investors, we frankly don't care. We buy properties that cash flow on a monthly basis. So we don't really care what the prices do. All we care is,
so basically what you're doing is you're buying and holding.
Right.
Call it. Okay. Right. And depending on the number of doors that you have, is where your cash flow is coming in. So if you have a multifamily unit or if it's houses or whatever, my husband and I are partner investors with a contractor that invests in multifamily, right? And that's a buy and hold situation. So there's monthly cash coming in from that. Now, there's a lot of these organizations out there and real estate experts out there that talk about the ease of getting into real estate and how you can turn that into passive cash flow. Is it really as easy as they claim it is, or what are some hints or things that you can tell our audience if they're looking to get into this arena? What should they know going in?
Yeah, I mean, like exactly to your point, there's a lot of charlatans kind of selling people on this, call them gurus. They come into town, they do the big dog and pony show, they place spectators in the audience that run to the back of the room to buy the product, which is why I've kind of focused on providing a lot of this stuff through the podcast and website for free. And what I've always kind of been burned up with that is they always focus on people who don't have money. So they sell people on hopes and dreams and prayers, where, I mean, to me, like a lot of my clients, they have good paying jobs, successful businesses, where they are actively trading their money at a high rate. But where we come in is we teach them how to invest passively, because at some point you can only work so hard at one hand. It's smart to take the money and put it into the other, the more passive side. Unfortunately, with passive investing, you need money to invest. If you don't have money to invest, y'all can't invest. And that is the key difference here.
And now talk a little bit about the investment side of things, because what we did, meaning my husband and I, when I left the workforce, I had my 401k, and we turned around and reinvested it into an organization that would let us self-direct it. All right, so that we could self-direct it into investments, and then the cash flow coming in from that would go right back into the 401k. So therefore, you're building your 401k at a higher interest rate than you are if you're just doing stocks, bonds, whatever, that type of thing.
Right. I mean, essentially, whether it's in a retirement account or not, which we can kind of get into. I'm not a big fan of retirement accounts, because that's not what the wealthy do. The wealthy do very different things than what we're all taught. And, I kind of got lucky and learned this early on, that the wealthy buy assets that put money in their pocket every month. And a lot of things like mutual funds, these Wall Street options, they just don't do it. They don't do 401ks and stuff like that. They do things very differently, but I got lucky that I kind of found the right people that taught me the right things. And I was able to learn by, having peers that kind of did this stuff. What were the secrets of the wealthy? And it's something that anybody can do, but it's for, your parents don't know how to do this, your friends and family, your coworkers, they're all doing it the traditional dogma type of way, unfortunately.
Right. These organizations that are out there peddling these real estate, courses and things like that, and requiring $20,000, $30,000, $40,000 to join. And they're talking about tax liens, and they're talking about flipping properties, and all of this. These are the shows that you see on HGTV.
Yeah, I mean they're on every channel. Right? It's so popular, right? Yeah. For good reason. It is. I mean, I kind of find myself watching from time to time.
Oh, I do. Just for I like seeing the transformations, but as you said, you have researched how the wealthy do their investing, but what about those that are not wealthy? They may have a very large investment in their 401ks or their retirement accounts, TO accounts, all of that. But maybe they might want to get involved in this. And what tips do you have that they can possibly start out doing this?
Yeah. So I mean, essentially, you got to get on this escalator at some point. If you're bad with your money, you spend too much, or you don't make enough money to be able to have a comfortable amount left over at the end of the year. And I would say anything between $5,000 per year to $30,000 that you can save, you got to work on your personal finances. And I'm not the person to follow for that. There's hundreds of different blogs and articles on that. Mm-hmm. But for most working professionals, people with successful businesses, you've got cash flow. You've got a positive stream of cash flow. If you're a non-accredited investor starting out, or especially under $250,000 net worth, I would start off like how I did, buying single-family home rental properties.
Right.
The key there is buying properties that meet this 1% rent-to-value ratio, so that that it'll cash flow on a monthly basis. So you take the monthly rent divided by the purchase price, and you're looking for that 1% rule or higher. So, for example, we'll start people off with a lot of these $100,000 properties.
Right.
If you live out in the East Coast or California, you probably think we're crazy, right? But most people in America live in good, solid 3-bedroom, 2-bath, $100,000 that rent for $1,000 a month.
Right. That's exactly it. I know here a 3-bedroom, 2-bath rental is going to be, right around $1,600, $1,800 a month here in Orlando.
Right.
So,
And that would cost maybe $300,000. So
yeah,
$1,600 divided by 300 grand. It's a little bit more than 0.5%. And not going to work. You
yeah.
need 1% or higher to be able to cash flow.
Okay. Well, that's, we own a property in Sanford here. It's completely paid off, but it's really not a popular. It's a 2-bedroom, 1-bath, but it's free cash flow for us. But it's not.
Yeah. Well, that's another big mistake that a lot of people make, right? They have this idea to pay off properties because they're debt averse.
Right.
The wealthy use debt prudently, right?
Right.
There's a difference between good debt and bad debt. Essentially, what you have to do as an investor is, it's nice to have cash flowing properties. That's what the website's called, right? But what's at the end of the day, what the wealthy look at is the impact to their net worth. When you're not prudently leveraged, when you have paid off properties or close to be paid off properties, you're still bringing in the same amount of income in.
Exactly. Therefore,
your return on equity is very low, right? So imagine if you own $1 million property and you're bringing in $3,000 a month or $36,000 a year. Of course, you have to pay a lot of expenses. Usually 50% of that goes to expenses. You're only making 1 to 2%. Right. But if you had effectively leveraged that, it would be 20 times higher than that.
Okay. Well, that makes sense, as far as that's concerned.
But most investors invest like that, right? And it's not a good strategy, but it works. And that's how good real estate is. You can have not the optimized strategy, but in 10 to 20 years, you're going to have 1 to 2 paid off properties. But what we like to get people is let's effectively leverage the properties so that they can safely cash flow every month, but grow their net worth aggressively at the same time, which means as their equity position goes up, maybe they're, certainly before they're half paid down on the mortgage, they go and either refinance, cash out, take the money out, or they sell the asset, buy 2 or 3 in its place.
Okay. All right. Well, that makes sense. So in a market like now, okay, I would imagine you're not buying a lot of properties, right?
There's always properties to be found, right? Whenever you read headlines, headlines kind of are just averages and medians. At some point, as a more experienced investor, you should be kind of going more towards the pocket deals out there, the deals that outliers, as we say. And we actually work more in the commercial real estate space these days, which isn't dictated by comparable sales or emotion, essentially. This is why we buy larger apartment complexes to kind of get away mom and pop investors, kind of swim a little bit upstream, where we pay for how much the property makes money based on net operating income, or for the business owners out there, essentially sort of like a beta, right? We pay the property's value is based on a multiple of its profits. Right.
And and also the occupancy rate. Well, that is the profits when you talk about, occupancy, and things like that. Because the apartments or the projects that we invest in the multifamily. Usually it's going to be the college multifamily, the apartments around various universities and things like that. Okay, that's where we're investing. And then also in strip malls. We're actually investing in some strip malls as far as that's concerned. What do you have to say about the commercial side on that side?
We like residential multifamily, but I kind of differ is I like workforce housing. To me, college towns and military towns, you're at the whim of the military, and should a college just decide to build up a dorm, right? I think in most Division 2, Division 3 campuses in small tertiary markets, you should be fine. But normally, again, we're trying to buy properties in areas where it's at least 500,000 population or larger. Yeah. So you're going to have a Division 1 college. So typically they're going to have a pretty robust housing system there. College housing and military housing is just a small portion of your population out there. We would prefer to be in at least a cohort of, or a tenant base of, the majority. So your lower middle class working wage earner, making anywhere from 30 grand to $80,000 a year. And then this is where, this country population is going up. We all know the thesis on the growing lower middle class, the shrinking middle class as they go, and they have the only thing they can afford are, value-based apartments like ours between the $700 a month to $1,400 a month.
Right.
And it's kind of more, to me, it's more stable and less based on some kind of government program or a third party university or something like that.
And how do you manage the management of the property management? Do you have a property management firm that you hire, or do you have your own division, or what?
Yeah, so we play the role as asset managers, but we employ property managers under us. So in the commercial real estate space, the reason why we like the commercial side is, as opposed to residential real estate, a lot of times you're not aligned with your property manager. For example, the property manager makes more money when you have a vacancy and they have to fill it, and they take a half a month or the full month's rent.
Right.
With us, we drive our property managers based on profit and loss and different KPIs that are more aligned with what ultimately what we want is our profits as owners and operators.
Okay.
But I think you get to that point later on, and most accredited investors they jump into syndications and private placements as passive investors where they don't put any debt in their name. They don't have any management responsibilities and have very little legal liability. But, I don't think you can start there, especially if you have a lower net worth.
Right.
I didn't have that when I graduated college. I had to buy 11 rental properties before 2015 to get my net worth up to a certain level to become accredited so that I could participate in these private placements and syndications.
Huh. Yeah, right now we use trusts a lot for a lot of our things, as far as the properties and stuff like that, to keep them out of our name.
Yeah, but you're still the managing member, right? You still got legal liability.
Managing member, yes.
Yeah. So this is what I learned when I had 11 rental properties back in 2015. 11 rental properties gave me a few $100s of cash flow per property. I was cash flowing maybe $3,000 a month. Not going to complain. Most people would love to have that, right?
Yeah.
But I quickly saw the writing on the wall that, with 11 rentals, I had maybe an eviction or two every year, some kind of big issue that happened, like a tree falling on the house, some kind of big plumbing repair happens every quarter. And I'm like, all right, well, I need more like $10,000 passive a month. Therefore, I'm going to need 30 of these houses. So multiply that exception rate by 3. Talking an eviction every other month, some kind of big catastrophe that happens every 2 weeks. Yeah. And about this time, I started to join different masterminds, get around other higher net worth doctors, lawyers, engineers, entrepreneurs.
Right.
And they were all investing via this form of syndications where they come in as a passive LP within their trust, or a lot of people own their ownership personally, but they diversify over dozens of deals. And now they're able to choose different asset classes, different partners, different geographic location, and different deals. Right. And that was the way that they also unlock all these extra tax benefits. So like on our larger properties, we'll do like a cost segregation, take this huge bonus loss, depreciation loss, and some people are able to offset all their ordinary income through that strategy.
Yeah. Huh. It's a complicated topic when we start talking about, the diversification and protecting yourself, like I said, with trusts, or as you said, asset management, all of that. It gets pretty complicated. If you are considering getting into this industry, what would be the 2 or 3 primary key points that you want to get across to somebody who's looking to?
It seems kind of complicated, but the reason why it's simple passive cash flow is that at the end of the day, it's very simple. The problem is there's just a lot of noise out there, right? Everybody's jogging for your attention. Tax liens, this, wholesaling, this.
Flipping, yes.
Flipping coupons, there's a very small subset of in the world of real estate investing for high net worth professionals that have money to invest, what optimal set of strategies for investing, tax, legal, and legacy creation. That's what simple passive cash flow is all about, right? Distilling those best practices that the wealthy do. That's very different. And it is kind of complicated because there's nobody around you that can tell you how to do this, because my parents didn't know how to do this when I was at work. Those are the last people you want to listen to. People stuck at day jobs all day long.
Right. And that's what you want to get out of,
Right.
And even getting out of that day job and starting your own business, it can still be considered a J.O.B. if you don't do, strategically put yourself in a position where you're not doing all the work. And that's what you're talking about doing, is this passive income, and through the syndication and everything, getting away from doing all the work and just collecting, your paycheck at the end of the month, whatever.
Right. And I think this is to compound this even more, right? People think, well, I can just go to CPAs and attorneys and get advice from them, which to me is not the case. I would say 90% or more of these so-called professionals don't have a clue how to do this stuff. I mean, that's why they're still working their own day jobs, right? They figured this out and had insight on how the wealthy do this. They wouldn't be going and clocking in at their so-called self-business that they own, where they're trading their time for money still.
Okay. So there's not anything that, like you said, you participated in some masterminds and things like that to learn, where would you recommend, recommend they go to get the education that they need?
I would say, I mean, it depends on where you're starting, right? Like if you have some money to invest, you want to buy a $100,000 property and you have $20,000 to $30,000 for a down payment, cool, you can get started, right? And that's how I would suggest starting out, just buying a rental property, and you'll get on the escalator and you'll learn from there. And then more importantly, you'll meet the right peers and pure passive investors to expand your knowledge base. If you're an accredited investor, you've got a little bit more options. You can jump into private placements and syndications for the SEC right off the bat. But I would suggest just learning and getting educated. If you're looking to buy rental properties, go to simplepassivecashflow.com/turnkey. That's kind of my free guide to buying these turnkey properties. I guess we didn't define turnkey, but turnkey is these properties you can buy from these rehabbers. They'll fix a property all up new for you, new electrical, plumbing, new roof, new appliances. Sometimes they'll even put a tenant in there for you. So it's kind of like a rental property with training rules. That's how I started. I was a busy professional, and great way to get started, without having to go and do this all by yourself and backwards engineering everything. But I think all roads lead to the passive route at the end of the day.
But as you said, the key is to a good investment is the monthly rental that you plan on pulling in divided by the overall purchase price has to be 1% or more.
Right. And then the next step is to put it into the analyzer. The 1% rule is kind of a quick and dirty.
Right, exactly. Then you have to look at, the expenses that are going to be involved with it. If there's any rehab or anything that needs to be done to it,
I'm a big proponent for doing very light to little to no rehab. That way you can get the loan for the large amount and not coming out of pocket for all the other stuff, not being able to leverage it.
Right.
But something in a halfway decent area hits that 1% rule, I think you're cooking. And then the next step would be, people can download my free analyzer. It's an Excel spreadsheet that kind of breaks down all the income and expenses. They can see repairs, property management. And that's where you really have to kind of fine tune the numbers to make sure you're going to be able to cash flow on a monthly basis.
Really?
People can download that at simplepassivecashflow.com/analyzer right there.
Okay. And then if we're looking at, say, commercial rentals or anything like that, or even single family homes, for rentals or whatever, what are the guidelines that you look at when you're looking at an area? You said 500,000 or more population?
Yeah, you're looking for more of like a large tertiary or secondary market. Primary markets such as all of California, Seattle, Boston, New York, it's not going to work. You're not going to find cash flow there. You might as well not even look. A lot, and this is where it comes in, where where you live probably won't be a good place to invest, unfortunately. I would never buy a house here in Hawaii, or I would never buy a house in Seattle. They just don't cash flow. They're more appreciation markets. So we target locations where the population is going up due to job growth, more red states, because when we're the landlords, we want the landlord-friendly laws on our side. To me, if you can't pay, you can't stay.
Yeah. No, that's exactly.
I still got to pay my bills as a landlord, so make my debt payments. So those are kind of the big criteria. A lot of states that we focus in on are like Arizona, Texas, Alabama, Georgia, and a lot of those Sunbelt states, because not only a better economic growth down there, but that's where the population is generally moving towards, from the northern states to the southern warmer states.
Okay. Speaking of, I'm in Florida. Okay, and there's a lot of multifamily commercial properties going up right now. They're building quite a few of them down here.
Orlando, right?
Orlando, yes. Now, my question is, the other thing that's really, pre-COVID had really been hot and heavy were the investment properties that were rented out for Airbnbs and the VRBOs, and things like that. What are your thoughts on that type of an investment property?
Again, that's like the college rentals and the military rentals. It's a very small niche, right? The thing about niches is like you can be lucrative, but to me, I prefer to invest in where the majority of the clientele can be, which is lower middle class, just boring rental properties where everybody can invest in. Short-term rentals are more your discretionary item. It's for people going on vacation. And I think this is where it's important to diversify around in different asset classes. You never know what's going to be next. Who would have known that a pandemic, impacted hotels and restaurants and shopping malls. Strip malls are okay. I don't mind strip malls, but like the malls of America are dying, right? Nobody wants to go to a mall.
Any of those enclosed malls are now going by the wayside. But when you start talking about, like I said, these investment properties that are being used as vacation homes here in Florida, they're really popular because people are.
Yeah,
it's more feasible for them to rent a home as opposed to going to hotel rooms, and things like that.
Yeah, so we prefer to be on, I guess we didn't talk about it too much, but like in terms of rental class, there's A class, which are the luxury, nicer properties.
Right.
We try and stay in the B and C class, which are your lower middle class areas. Definitely not in the war zone type F properties.
Yeah.
But in the sweet spot, because the idea and theory is in hard times, the A class moves to the Bs moves to the Cs, where we are. So in hard times, nothing's recession proof, but I feel like when you're in the sector of class B and C housing, there's probably, you're poised a lot more stronger position than any other asset class out there. Where if you have a short-term rental, you're screwed, absolutely screwed with that. Yeah. And you can't rent, you can't rent it out long term because you're not going to cash flow in that property. And this is another thing, like we try and stay away from things where the mom and pop unsophisticated investor can just get into. It's very easy to get a nice Airbnb, get it set up on Airbnb or make a little website and go. We really want to try and stay away from the mom and pop investor, which is why we kind of stick to like 60 to 100 unit plus apartments.
Okay. And that makes sense when you talk about, now did the recent recession that we had where a lot of people were upside down in their homes, losing their homes, did that positively affect you on the rental side?
I mean, that's why we like apartments too, right? I mean, I don't really have any residential properties, little rental properties here or there anymore. But in my opinion, whether it's take it for what it's worth, right? I'm just looking at my crystal ball, but I feel a lot of pain coming through as a lot of these people have deferred their payments.
Right.
And there's going to be some foreclosures. I don't think it'll tank the market, like help some people like to, sell YouTube videos and newsletters like to say. Ultimately, a lot of those guys are just trying to sell you on gold. So always check your sources and what's their means and reasons for doing what you're doing. But to me, I mean, as I kind of look at my own business, when people have to move out of their houses, where do they go?
Yeah.
Well, they go to their value-based apartments. So here we are. We'll be open.
So where do you see the market going right now?
I'm pretty bullish. I mean, you look at all the unbiased data out there. A lot of them are saying that GDP growth will be 4 to 6% these next few quarters. There really wasn't anything wrong with the economy to begin with. There is rampant inflation at this point. So what you want to be doing is buying things that go up with the pace of inflation, such as real estate, ideally at cash flows, right? And it is kind of sad, right? Because people who don't own anything or maybe own their houses outright, right? They're seniors. They're going to be screwed because their dollar is going to be robbed from them in their sleep and when they're awake by inflation.
Yeah.
And that's the sad part.
Yeah, no, I agree. This is the type of industry that does take a lot of foresight, a lot of, being able to see the trends coming down the pike, and being able to follow those cyclical cycles. COVID threw a monkey wrench into that cycle this time, as far as that's concerned. But we're getting close. We are at the end of our show right now. Do me a favor, Lane, and tell everybody how they can get a hold of you if they want more information, and also repeat the address where they can download your calculator. Yeah,
so if they want to get that free analyzer, they can go to simplepassivecashflow.com/analyzer. If you're not an accredited investor, what I would suggest, start out with a rental property. Simplepassivecashflow.com/turnkey would be the place to go for that. My podcast, when I started it back in 2016, I talked a lot about buying single-family home rentals remotely. As I became more of an accredited investor, the topic materials have changed quite drastically to where it is today. But, you guys got to, if you keep doing what everybody else is doing, you're going to get where everybody else gets, work another 40, 50 years. I got lucky and I kind of stumbled upon this very early. And, in my little rental property, I made like 10, 20, 30% returns on my money. And it wasn't that great of a rental, in my opinion.
Yeah.
And I was like looking at my 401k. I'm like, supposedly I'm making only 8 to 10% and it goes up and down like a roller coaster.
Right.
And I was like, well, what the heck? Right. And as I've seen many people do, kind of after I've met with them, if everybody just followed what I did and got on the path of buying a handful of rentals, they'd be financially free and very quickly, a lot of times less than a decade. But, society will not function if everybody did this, right? It's daunting. It's different. Nobody else does this. You're going outside your comfort zone. And like everybody, we need people to get our coffee and build bridges, right? Society would not function if you just bought a handful of rentals and pieced out. Yeah, that's true. That's true. You need those that do, and those that, can think outside the box and can, so yeah, no, definitely. Anything else? Any last tips you want to leave us with, Lane? Yeah, just get started. I mean, I think this stuff does work. It's not easy, but it's very simple. Right. Okay. All right. Well, I really appreciate you spending time with us today, Lane, and congratulations on that new little girl. What's her name? Kira. Kira. Oh, beautiful name. Beautiful name. And that's the end of this segment, and I look forward to talking to everybody next week. Thanks again, Lane, and that's it. All right.